Investing in the financial markets can be a rewarding way to grow wealth, but it also comes with inherent risks. Market volatility, economic downturns, and unforeseen events can lead to losses. Reducing risk in your investment portfolio is crucial to protect your investments and ensure long-term financial success. By employing strategies that diversify risk, focus on stability, and manage exposure to different asset classes, you can better safeguard your portfolio. In this video, we'll explore the top 10 ways to reduce risk in your investment portfolio. 1. Diversify your investments. One of the most effective ways to reduce risk is diversification. By spreading your investments across different asset classes, stocks, bonds, real estate, commodities, and industries, you can minimize the impact of poor performance in any single area. For example, if the stock market takes a hit, bonds or real estate investments may perform well and offset losses. Diversification helps balance risk and returns, lowering the chances of a significant loss. 2. Invest in low-cost index funds and ETFs. Index funds and exchange-traded funds, ETFs, offer a simple, low-cost way to diversify your portfolio. These funds typically track a broad market index, such as the S&P 500, and provide exposure to a wide range of stocks or bonds. By investing in these funds, you can gain diversification across many sectors without the need to pick individual stocks. Moreover, low fees associated with index funds and ETFs help improve long-term returns. 3. Balance your asset allocation. The allocation of your assets, stocks, bonds, cash, etc., plays a key role in managing risk. The right asset allocation depends on your investment goals, risk tolerance, and time horizon. Younger investors with a longer time horizon may choose to allocate more toward equities, which typically offer higher returns but come with more volatility. Older investors or those seeking lower risk may allocate more to bonds or other safer investments. Regularly rebalance your portfolio to maintain your desired asset allocation and avoid taking on more risk than you're comfortable with. 4. Invest in high-quality bonds. Bonds are generally considered safer investments than stocks, but the risk level varies depending on the type of bond. High-quality government bonds, e.g., U.S. Treasuries, or investment-grade corporate bonds are relatively low risk compared to junk bonds or bonds from less stable countries. Including high-quality bonds in your portfolio can provide stability and act as a buffer against stock market volatility, offering more predictable returns. 5. Consider dollar-cost averaging. Dollar-cost averaging, DCA, involves investing a fixed amount of money at regular intervals, regardless of the market's performance. This strategy helps mitigate the risk of market timing by reducing the impact of short-term market fluctuations. Over time, DCA lowers the average cost per share, especially in volatile markets, and helps smooth out the highs and lows of the market. This method can reduce the emotional stress of investing during market downturns. 6. Avoid overconcentration in single stocks. Investing too heavily in a single stock or sector can significantly increase your portfolio's risk. While individual stocks may experience periods of strong growth, they can also be subject to sharp declines based on company-specific events, such as management changes, regulatory challenges, or competitive pressures. By limiting exposure to any single stock or sector, you reduce the likelihood of a major loss from one investment. 7. Maintain an emergency fund. An emergency fund is a critical part of managing risk in your overall financial plan. It provides a cushion in case of unexpected expenses, such as medical bills, job loss, or market downturns, allowing you to avoid selling investments in a down market to cover immediate needs. Ideally, an emergency fund should cover 3 to 6 months' worth of living expenses, kept in low-risk, liquid assets like a high-yield savings account or money market fund. 8. Invest in defensive stocks. Defensive stocks, also known as non-cyclical stocks, belong to sectors that tend to remain stable regardless of economic conditions. These industries include utilities, healthcare, consumer staples, e.g., food and household products, and telecommunications. Defensive stocks are less sensitive to market fluctuations and can provide a reliable income stream during economic slowdowns, thus reducing the overall risk in your portfolio. 9. Hedge against inflation. Inflation erodes the purchasing power of money over time and can negatively affect your investment returns. To mitigate this risk, consider adding inflation-protected securities, such as Treasury inflation-protected securities, TIPS, to your portfolio. Other options include investing in real assets like real estate, commodities, e.g., gold, or stocks from companies that have pricing power and can pass on higher costs to consumers. 10. Monitor and adjust your portfolio regularly. Risk management is an ongoing process. It's important to monitor your portfolio regularly to ensure it remains aligned with your financial goals, risk tolerance, and changing market conditions. Rebalancing your portfolio periodically ensures that your asset allocation stays in line with your target. For instance, after a strong performance from equities, you may need to sell some stocks and invest in safer assets to maintain your desired risk level. Staying informed about market trends and adjusting your portfolio accordingly will help minimize risk over time. Reducing risk in your investment portfolio is crucial for protecting your wealth and achieving long-term financial goals. By diversifying your investments, maintaining a balanced asset allocation, investing in high-quality bonds, and employing strategies like dollar-cost averaging in defensive stocks, you can reduce exposure to market volatility. Additionally, monitoring your portfolio regularly and hedging against inflation will help ensure that your investments remain resilient in changing economic environments. While no investment is entirely risk-free, implementing these strategies can significantly reduce risk and improve your chances of achieving a stable, long-term return.